Hi, my name is Jeff. I'm going to teach you two things. One, how to analyze the performance of a business. Two, how to understand business strategy. So if you're looking to become a business analyst, or if you want to transition your career from a technical path to more of a business path, or if you're looking to develop some business acumen to take on a management role, you've come to the right place. With this video, I'm not going to lecture. The idea is I'm going to do the analysis with you so you can see how it's done in the real world. I'm going to do it the way that I would do it if I was doing it myself for work. And with that in mind, just a little bit about me. I'm the Chief Strategy Officer for an industrial reliability services company. I have a PhD in mechanical engineering from Caltech, so I come from a technical background, and I've been doing data-driven pricing, profitability, and market intelligence work in industry for about a decade at this point. And so that's the experience I bring to bear on this problem, and that's what I'm going to teach you is how this kind of analysis would actually be performed in a real-life corporate strategy organization. So before we get to what you need to perform this kind of analysis, let's go ahead and talk about what you don't need. You don't need a bunch of fancy technical skills. You don't need a business degree. And you don't need finance experience. What you do need is an aptitude to do some pretty simple arithmetic. You need curiosity, and you need an interest in storytelling, because we're going to use this data to tell a story about where these businesses have come from, where they are today, where they're going in the future. So that marrying up that storytelling to the data analysis we're doing is very important. So that's why you need that interest in storytelling. That's what's going to make our analysis stand out and different than just throwing a bunch of numbers into an Excel book, creating a line chart or a bar chart, and tossing it over the fence to some stakeholder to take a look at. So in our case, we're going to use Disney as our first example. I think it's a great example to choose. It's a massive corporation that's globally recognized, has characters that are recognized the world over. And so from that standpoint, it's an easy one to sink our teeth into because a lot of us have some familiarity with Disney. It's also a publicly traded company, which means that we get a lot of good data about its performance, and we get access to its management team. We get to hear its leaders talk during earnings calls. In the case of Disney, because it's so big, it's covered by the business press. So we also get exposure to Disney's management team through, we might watch CNBC or Bloomberg Television. We might read in the Wall Street Journal. So even through just regular business press, we get access to the management team and get to learn even more about the company and what senior leadership is thinking about how it's performing and what it expects of the business going forward. Finally, Disney also has a pretty straightforward strategy that we don't have to do a whole lot of homework. We don't have to do a whole lot of building up of our vocabulary to be able to talk competently about the business. It's a pretty straightforward model that we can understand as we go through this analysis. And then finally, all the resources that I use over the course of this video, I'm going to include links in the video description so you don't have to frantically try to copy down which URLs I'm going to and how to find them. I'll document all of that for you. We're going to start our analysis with financial data. Because Disney is a publicly traded company, it reports its financial results to the U.S. Securities and Exchange Commission, the SEC. And then specifically, the SEC has a system they call EDGAR, the Electronic Data Gathering Analysis and Retrieval System. EDGAR is what we use to go find a lot of this data. And we'll just manually pull that data out and dump it into Excel books. And that's what I'll show you how I'm doing it. Here, let's go ahead and search for the SEC EDGAR webpage. And searching Google for SEC EDGAR, we get to the first result is exactly the page I'm looking for. And let's go ahead and blow this up a bit. What we see here are the EDGAR company filings. This is the box we want, company and person lookup. And all we have to do is start typing Disney. And sure enough, it's DIS is the Disney ticker, the stock ticker, and it's the first result that shows up. So we can click on Walt Disney Company, and that gets us to its company page. Now, we see a company information box that we can click into. We get some information from the SEC for its reporting data, so we can go ahead and minimize that. We see some of Disney's latest filings. What I'm personally most interested in is this selected filings, specifically the 10K annual reports and 10Q quarterly reports. This is the section that I want to look at first. And we see in this list the very first item listed, November 24th, 2021 is when the 10K was published. Annual report for the year ending October 2nd, 2021. That date is important for us to keep in mind that Disney does not report on a calendar year. It reports on a fiscal year that runs from the beginning of October one year to nominally the end of September the following year. So all we have to do is click into this 10K, and now we'll be looking at Disney's annual report. So again, let's go ahead and blow this up so we can see it a bit better. Form 10K, Disney for the fiscal year ended October 2nd, 2021. And now we can just start scrolling down the report to get a sense of what's in it and what we might want to pay attention to. We see here the table of contents. There's two items in this table of contents that I really want to pay attention to. The first is item 1, business. This is going to tell us a lot about Disney's business, how it's structured, how it makes money, what it's working on today, just a general purpose list of items that Disney's management team wants investors to know about the business as a whole. Next is item 8, financial statements and supplementary data. That has, as you would imagine, the consolidated financial statements for Disney. There's 3 big financial statements that we really want to pay attention to when we're doing our analysis. The first one is a consolidated statement of operations, which is also called an income statement. The second is a balance sheet, and the third is a cash flow statement. And we'll discuss a little bit what each of those 3 financial statements has on it and why we're interested in each of them. So those are the 2 areas that we really want to pay attention to when we're doing our analysis here on Disney. So we can go ahead and click into item 1, business. And we see here that the Walt Disney Company, together with its subsidiaries, is a diversified worldwide entertainment company. And it talks about having 2 segments of operations. And we'll go through that in our analysis here. But again, COVID-19 pandemic, its approach to human capital, people that are working at Disney. There's just a laundry list here of items that the management team at Disney wants investors to know about its company. When you're performing a new analysis for a company that you haven't explored before and don't have a whole lot of familiarity with, I would spend some time in item 1 of its Form 10K. You'll really get to learn quite a bit about the business, how it's structured, how it makes money, the big initiatives that are occurring at the moment. These are all the things that the management team really wants investors to know and to pay attention to orient themselves around the company and its value proposition. So it's a great way to get firsthand information about the company that you can use to better decide what data you're going to collect down the road and what areas of the company you really want to dive into to better understand its performance. We can go back to the table of contents. And now that we have a sense of what is an item 1 business, let's go ahead and go to item 8, financial statements and supplementary data. Again, we can just click on the link. And it says see index to financial statements and supplemental data on page 63. So we can click on that, and now we get to our list of financial statements. The one we want to start with is this first one, consolidated statement of operations for the years ended October 21, 20, and 19. And that's on page 67. We can click that. And now this is what we're looking at, the consolidated statement of operations. This is otherwise known as the income statement. And the income statement tells us about a company's revenues, its costs, and its profitability. And it's very important to know the costs that are being shown on an income statement are the costs that are tied to these revenues. These are the costs the company needed to incur to generate these revenues. And as a result, we can understand its profitability. So we see a bunch of data here from revenue, cost, all the way down to income or loss from continuing operations before income taxes. And you can get down to net income or loss and net income and loss attributable to the Walt Disney Company. There's a lot of good information here. I want to show you how I capture this data in my Excel sheet. It's a very simple system, but it helps me get all this data in one place. So if we go to Excel, what I've created is a sheet here with this structure in it. The first column, I list a segment. And so here, because we're looking at consolidated financial statements, the segment is consolidated, meaning it's consolidated across all the segments of the company. It's for the company as a whole. I'm capturing the year, in the first case of 2021, the period within that year, so we're looking at the fiscal year, FY. Item, I have 3 levels of items just so I can keep track of what belongs to what. The level 1 I'm calling revenue in this case, and level 2 is services and products. And there is no level 3 for revenue. There's just these 2 buckets within revenue. And then you see I capture the units, which in this case are all millions of US dollars, and we get to a value. So if we go back to the 10K, we see that services revenue for 2021, $61,768 million US dollars, meaning it's $61.8 billion. Sure enough, that's the first line of my worksheet here, just 61,768. I do the same thing for every revenue item across these 3 years, for every cost item across these 3 years. And I do it all in Excel, so that way I can create pivot tables and easily create charts to visualize a lot of this data. Now that we've gathered the income statement data from the 10K and put it into Excel, we can visualize that data and really understand how Disney's performance has changed from year to year. We see that 2021 revenue was $67.4 billion, which is $2 billion more than it was in 2020, but a little over $2 billion less than what it was in 2019. And frankly, that's to be expected. That's the impact of the pandemic. A lot of businesses suffered big time losses as a result of the pandemic, and Disney's was actually pretty mild, all things considered. So the revenue trajectory dropped a little over $4 billion from 2019 to 2020, but then rebounded by $2 billion from 2020 to 2021. The operating profit data really shows us the impact of COVID-19, that Disney generated almost $11 billion of operating profit in 2019, but then suffered a $2.4 billion loss in 2020. But again, the recovery into 2021, we see, because operating profit's now back in the black, at positive $2.5 billion, but still a far cry from the $10.9 billion that Disney generated in 2019. And dividing that operating profit by revenue, we get to operating margin. And again, we see a pretty dramatic impact of the pandemic. That in 2019, before the pandemic sets in, Disney has an operating margin of 16%. With the pandemic, after it sets in 2020, that margin drops all the way down to minus 4%. But again, a recovery in 2021 takes that operating margin back up to plus 4%. So we see the trajectory that we would expect to see given what we know about the dynamics of the pandemic. We've studied Disney's consolidated results from the income statement. So we've seen what's happened to its revenue, its operating profit, its operating margin. Now we can move on to what's happening within its two reportable segments. In the 10K, Disney's management team tells us it has two segments. The first, Disney Media and Entertainment Distribution. This is the one that covers television, movies, streaming services. Then there's the other segment, which is Disney Parks, Experiences, and Products. That's theme parks and all of the products you can think of, clothing and books and games, all the stuff that has Disney intellectual property associated with it. Those are the two reporting segments. We can look at that same income statement detail that we looked at on a consolidated basis for Disney as a whole. We can look at for each of those two segments to see how they're performing. And let's do that now. The top series of charts here is for the Disney Media and Entertainment Distribution segment. And the bottom series of charts is for Disney Parks, Experience, and Products. In the Disney Media and Entertainment Distribution division, we see revenue continuously marching up from $42.8 billion in 2019 to $48.4 in 2020 to $50.9 in 2021. We don't see a pandemic effect in the revenue stream for this segment of Disney. Again, this is movies, films, and streaming. So this is the kind of stuff that largely would suffer less of a disruption than in-person activity like you would imagine at theme parks. Again, you see a pretty flat walk across operating profit, which isn't surprising because Disney is spending a lot of money to generate new content, specifically for its streaming service, Disney+. So we see a flattish profile across operating profit, even though revenue is going up, likely because expenses are climbing as well. And then we see the operating margin drop slowly from 18% in 2019 to 16% to 14%. And again, the assumption here is that there's a lot of ongoing expenses that Disney is incurring to generate content for that Disney Media and Entertainment Distribution segment. Then we get to the Parks, Experiences, and Products segment. And here we see the disruption that we would expect from the pandemic. We see revenue of nearly $27 billion in 2019 that drops to $17 billion in 2020 and a little less than that to 16.6 in 2021. The operating profit also basically falls off a cliff from $7.3 billion in 2019 to $500 million in both 20 and 21. And the operating margin shows us the trajectory that we'd expect, a 27% margin at pre-pandemic levels that drops to 3% for both 2020 and 2021. We've looked at income statement data both on a consolidated basis for Disney as a whole and for its two reporting segments. So now we can move on to the balance sheet, which typically we only get for a consolidated basis for Disney as a whole. But the balance sheet tells us what the company owns and what it owes. So in other words, we get some good information around, say, the cash balance, around how valuable Disney's parks are, all the equipment it owns. But we also get some information about the debt that Disney has and the claim that stockholders, say, have to Disney's assets. We get all that information off the balance sheet, and we can take a look at that one right now. The green bars show us Disney's cash position. We see that Disney had $5.4 billion in cash in 2019, and that rose pretty dramatically to $17.9 billion in 2020 and dropped a bit down to $16 billion in 2021. The yellow bars are showing us debt, and we see $47 billion of debt in 2019 that jumps up to nearly 59 and then back down to 54. And we see equity, which is the claim that stockholders have to the Disney's book assets that would appear the way they're valued on the balance sheet. And again, we see stockholders' equity drop a bit from 2019 to 2020, but then recover back to $93 billion in 2021. And finally, we get an interesting ratio, or at least a ratio that I find interesting for a lot of these companies, which is net debt to equity. Net debt is total debt minus cash. And we divide that by equity to give a sense of how highly leveraged is this company? How much debt is it taking on for the claims that stockholders have against the assets of the business? And here we see that Disney had a leverage ratio of 0.44 going into the pandemic, and it did increase slightly to 0.46 the year the pandemic sets in. Very interestingly, that leverage comes down in 2021 from 0.46 down to 0.41. So what this tells us is Disney is doing a very effective job of making sure that it's not taking on a ton of debt in order to make it through the pandemic. It is right-sizing its business. It's controlling its cost profile given the revenue streams that it's generating. And it's making sure that it's not going to drown itself in debt in order to make it through this pandemic. So that's a good sign for the long-term sustainability of Disney's business. And we get that just from looking at some pretty high-level information that we can pull directly off of the balance sheet. So far in our analysis, we've just focused on Disney itself. We've looked at its income statement. We've looked at its balance sheet. And we've gotten some understanding of how it's performing, what's been happening to the business over the past couple of years. Now we want to get to the point where we're introducing some context. We're not just looking at Disney in a vacuum, but we're adding in some new data to compare Disney's performance against. The first step that we're going to take here is let's go ahead and compare the Disney Plus, which is Disney's streaming service, the Disney Plus subscribers to the number of subscribers that Netflix has. And that's what we see in this chart. This chart starts in 2010 and marches all the way through 2021. And we see the light green bars are the Netflix subscriber numbers. And Netflix streaming service launched in 2007. So we pick up this story in 2010, and we see that Netflix has 17 million subscribers at that point. And then over time, the subscriber count only goes up, which is what we've heard about and expected to see. And we see by the time you get to 2021, Netflix has 214 million subscribers. Now, we're going to compare Disney Plus's subscribers against Netflix. Importantly, Disney Plus didn't launch until 2019. So we don't see any purple bars until we get to 2020, because 2019 is the first year. It basically launches during that fiscal year. So we see 2020, in its very first year, Disney Plus got 74 million subscribers. And we see that it took Netflix from 2007 to 2016 to get 74 million subscribers. And if you remember reading any of the business press shortly after Disney Plus launched, investors were very excited about how quickly Disney was able to add to its subscriber base, in part because we knew what Netflix had done, how long it had taken to get to that kind of number. And then we see that Disney gets to 118 million subscribers by 2021, and it took into 2018 before Netflix got to that number. So this is a very exciting story for Disney, that it's adding subscribers very rapidly to its service, and that explains part of what Disney's trying to do with adding as much content as it can, as quickly as it can, but still maintain a high bar of quality, because it's trying to give more and more customers a reason to subscribe to that service, either in addition to Netflix or possibly in some cases instead of subscribing to Netflix. So the Netflix comparison is one way to add context to the Disney story. Another way is we can study, say, just its theme park admissions revenue stream, and we can compare that to an external data set that gives us a sense of what might we expect to happen to that revenue stream. So in this case, I went ahead and chose a data set from the Department of Transportation, where it shows us all vehicle miles traveled in the US by year. And we can compare Disney's theme park admissions revenue to this vehicle travel data. We see in 2017, Disney theme park admissions revenue was $6.5 billion. It grows to 7.2 in 2018, grows to 7.5 in 2019. Then we see the pandemic hit, and the revenue's cut nearly in half, all the way down to $4 billion in 2020. And it drops even further into 2021 at $3.8 billion. Again, theme parks are largely closed. Even when they reopen, they don't reopen at full capacity. Not as many people are interested in traveling as far to go to these theme parks, and so it makes sense that the revenue stream takes as hard of a hit as it does across that period of time. The orange line is showing us U.S. vehicle miles traveled in millions. So we see in 2017, 3.2 million miles traveled, a slight uptick into 2018, a slight uptick into 2019, and then we see, again, a dramatic decline into 2020. Interestingly, it's not nearly as much of a decline as we see in Disney's theme park admissions revenue. And that makes total sense because, the theme parks are shut down. The highways weren't shut down. People are still driving. Some people are still commuting to work. People are still traveling to see family in some cases. So the highways are still very much being used, but clearly not at the rate that they had been the prior year. Theme parks are getting shut down. And again, even when they are reopening, they're not reopening anywhere near full capacity. So we see a much more dramatic reduction in Disney's theme park admissions revenue than we did in these U.S. vehicle miles traveled data sets. But again, we see a recovery into 2021 as people are traveling a little bit more. In the next step of our analysis, we can start to consider some strategic elements of Disney's performance. For any publicly traded company, the management team is fixated on the stock price. The stock price is, in a sense, the ultimate scoreboard that investors are using to assess the strategy that any of these publicly traded companies have implemented and are trying to execute against. And so the stock price is a good place for us to start an analysis of how has Disney's strategy been playing out over time. This bar chart here shows us Disney's stock price history by quarter going back to the beginning of 2019. And so we see a substantial increase from $112 per share in the first quarter of 2019 to $156 per share in the first quarter of 2020. And like with any stock price, you see some volatility, so you see some climbs up through 2019, you see a drop into the pandemic, into 2020, Q1 and Q2 is where its low point is, and then you see this recovery for Disney up into the beginning of 2021. But then over the past year, it's been tougher sledding for Disney. You see the stock price slowly grinding down over time, which is an interesting thing to know as Disney's revenue has recovered, as its operating profit has recovered a bit, it's getting back to normal pre-pandemic level performance. Its stock price is still below where it was nominally a year ago. And like we did when we looked at the subscriber counts for Disney Plus against Netflix, we want to put some context against these numbers. So we can look at Disney's stock price, but let's go ahead and compare it with a couple of its competitors, and two pretty important ones. One is Netflix, for the obvious reasons. They're competing in the streaming space together, and that's a space that's getting a lot of attention from investors and is capturing a lot of capital from companies that are trying to compete in that space. Let's also look at Comcast, which is a good competitor for Disney across its traditional film and television business. It also has a little bit of a streaming element to it. We can look at stock price for all three of these and get a sense of how Disney is faring. So now we're looking at stock price going back again to the beginning of 2019. We see Disney in the bolded blue line. We see Netflix in the lighter orange line, and we see Comcast in the gray line. Overall, Netflix's stock price has grown the most since the beginning of 2019 of these three companies. And we see that Comcast and Disney are tracking much more closely against each other than either of them would be with Netflix. And that tells us something. That tells us how investors are assessing the value proposition that each of these companies brings. That investors still look at Disney as being closer to what you'd get from a Comcast in terms of being more focused on films, more focused on television. That while the streaming bet is there, it's not seeing the value for Disney. It's not generating that value for investors, in the eyes of investors for Disney, that it has for Netflix. And it gets to a pretty important strategic consideration for Disney's management team is to what extent should it focus more and more of its capital on Disney Plus and less on legacy businesses like what it sees out of its theme parks or in its more traditional film distribution models. And that gets to some interesting questions for Disney's management team to answer, because Disney's philosophy to this point, and I would argue it should continue to be the case going forward, is that they want to own the whole ecosystem around their universes. They want to control the experience. They want to control the film development, how the characters are written and produced. They want to control the theme park environment, and they want to make all of this very prevalent in the minds of consumers. They want consumers to think about Disney, to live Disney, to know what Disney means, and what these characters stand for, and how families can respond and be entertained and fulfilled, and set up some of their own aspirations around what they're seeing and hearing in these Disney universes. Disney wants to own as much of that as possible. So being a standalone streaming service doesn't make a whole lot of sense given what Disney's trying to accomplish on the whole. Now the challenge is that Disney then doesn't get the valuation premia that a company like Netflix would, that's all in on subscribing, or on streaming rather, and only on streaming. And we see that reality here in the stock price. So this is something that Disney's management team certainly sees, certainly pays attention to, certainly has in-depth strategic reviews around, because this is an important element of what kind of strategy it's going to define and set for itself, and how it's going to invest its capital to achieve those strategic ends. And this stock price is a pretty good public demonstration of how Disney's performing in all of those areas. The last bit of analysis I want to do here is admittedly pretty goofy, but it's something that I am into and I'm really curious about, and so I tend to look at a lot of the publicly traded companies that I end up studying. I tend to make this look, which is into what their executives get paid, into executive compensation. It's a pretty interesting data set because you get an idea of what the highest profile people at some of the US's most visible companies make on an annual basis, and how it's distributed between what they get paid out salary and what they get paid out in bonuses and what their stock awards are worth. And so we can go ahead and pull this data again from the SEC Edgar system, and I'll show you exactly how we do that. So now we're back on Disney's page at the Edgar site, and instead of looking at this 10K annual reports and 10Q quarterly reports section, let's go to the next section, which is proxy annual meeting and information statements. And what we want here is the very first result, this January 19th, 2022, Def 14A, other definitive proxy statements. Let's go ahead and click on that one. This proxy statement, let's go ahead and blow it up too so we can read it a bit better. We get a lot of interesting information in the proxy statement, and I won't spend much time here covering all the different things we'll see in it. I really want to focus on the executive compensation, again, because I'm a bit of a nerd and I'm curious about what these executives are getting paid. And so what we can do is look through this table of contents, and we start to see the proxy summary, so different elements up here in terms of a fiscal overview and who their board of directors is and the rest. We get down to the bottom of this first page, we see executive compensation. So we can go ahead and click on this. We get a letter from the compensation committee basically explaining what the Disney's compensation philosophy is and how they set it and what it all means. And so we're going to keep scrolling down until we get to numbers for individual executives. So we're going to scroll. There's a lot of good compensation data. And again, if you're interested, this can make for a pretty interesting read of how Disney pays its executives. So here we get to individual compensation decisions, annual compensation decisions. And we see a list of executives on the left. We see salaries, performance-based bonuses, and equity awards. And actually, I know there's a table that'll give us totals. That'll be a better way to look at this data. So let's scroll down a little further, and we should find the next table. This is the one that I want, that shows, again, these executives, what fiscal year we're looking at, 2021, 2020, and in some cases back to 2019. What they get paid in salary, stock awards, option awards, non-equity incentive plan compensation, so bonuses basically, other kinds of deferred compensation, other compensation, and then you get to these totals. So for the chief executive officer at Disney in 2021, got paid a total compensation of $32.5 million. And Bob Iger used to be the chief executive officer, but until recently he was the executive chairman, and is now $45.9 million of compensation in 2021. And you can see in the pandemic year, his compensation dropped all the way down to 21 million. Poor guy, right? I don't know how he paid the bills with that. And then 2019, it was back up 47.5 million before the pandemic had set in. And you see, even the folks that are not the chief executive officer are making millions of dollars a year, in some cases tens of millions of dollars a year, to work at Disney. So nothing for us to immediately do with this data, but interesting nonetheless to get a sense of what the highest profile people at a company, the size and with the visibility and the glamour of Disney, what these folks earn on an annual basis. We've performed all this analysis, and the natural question is, so what? What might we do with it? Well, let's go ahead and think through, say the income statement analysis where we're looking at revenue and operating profit and operating margin. Maybe that's management team looking at this performance to understand, okay, how quickly should we expect the business to return to pre-pandemic levels of performance? Well, one easy way to go about at least kicking off the analysis is to look through what's our revenue been doing? What are our margins doing? And the next step would be, okay, what kind of costs are sitting between that revenue and profit line, and how have those been trending over time? And given what we've seen in the past and what we know the pandemic has done to our business and what we know the competition has done to our business and our strategic changes that we've implemented, what those have done to our business, how much longer would it take, do we think it would take in order to get the business back to how it had been performing before? We can get into, say, the balance sheet analysis that we had done, looking at cash and debt and equity and net debt divided by equity. That kind of analysis we might do, say, if we're trying to think through, imagine Disney's considering making some massive acquisition, and it has to decide, okay, how much cash are we willing to put into this acquisition versus how much additional debt are we comfortable taking on in order to fund this kind of acquisition? Or maybe we make it out of equity. We offer some of our stock in the deal. Well, this kind of analysis will help decision makers really understand what our appetite for debt looks like. And again, we saw that Disney actually is less highly levered with debt today than it was going into the pandemic. So it has a little more freedom and flexibility even than it did before the pandemic had set in. So this kind of analysis would really help us understand if we're going after a major acquisition, what sort of levers can we pull and how much range of motion do we have in each of these levers in order to accomplish these different strategic objectives. So that kind of balance sheet analysis would form an important part of the pre-work that we're doing to really assess what a path forward around an acquisition might look like. Or we can take the case of the comparison between Disney Plus subscribers and Netflix subscribers. That might be the kind of analysis that, say, a business analyst inside of Disney is doing to better understand its competition. It would almost certainly include more than just Netflix and competitors, but it would, there'd be other streaming service providers that they would include in that kind of analysis. When people do subscribe, and when they're brand new subscribers, what are they typically watching, the first week, 2 weeks, month into their subscription, and how does that change over time? Those kinds of data sets will give us more confidence in how to invest to further grow our content library. And then finally, we can look through the stock price history chart that we had, and we have that with some competition. And Disney's management team does that almost certainly to really understand how are investors valuing the company. What is the value of Disney Plus on a standalone basis, if you could carve that out? What is the value of Disney's theme parks? What is the value of Disney's merchandising business? And then we can start to really formulate our strategy to understand what's the value of having all those things together? What feedback loops exist where, because we have theme parks, that makes our Disney Plus streaming service even stronger. When families want to go on vacation, they could go anywhere and see anywhere. If we can bring them to a Disney park, they have Disney on their mind. They get more exposure to the characters. They have a lot of fun together. They form family memories that they regale each other with over years into the future. And so those stories become part of a family's identity. And so they connect more and more with Disney. And that makes them want to watch more and engage more and have more Disney merchandise and become repeat visitors to some of these parks. So there's real value in having a parks business tied into, say, a streaming business, as opposed to if we just carved each of those out and they were their own standalone companies and they had to license intellectual property from each other. You could start to make the argument that, while the streaming business itself might become incrementally more valuable, maybe the other two become a lot less so. And so on the whole, it makes a lot more sense that holistically this thing is worth a lot more together than it is in pieces. Or that series of analyses that we had done, are all relatively simple analyses. It's quick to pull that data. It's quick to run the arithmetic and to chart it out and visualize it in simple ways. But they are incredibly important analyses to perform. And almost none of them would, say in isolation, give you a ton of insight that you wouldn't otherwise have. They are important building blocks to really answer some needle-moving questions about the company and how investors view it and how employees view it and how its competitors view it and how its customers view it, how suppliers view it. And for for Disney to succeed, it needs to succeed across all those dimensions. So being able to build up holistic analyses using all these data sets to better understand what about Disney is functioning well and what can we improve. These are exactly the kinds of analyses that you would perform as a business analyst or as a manager or as a senior executive to really get to the bottom of these super important questions. So that's the so what. That's why we perform these simple analyses. In a vacuum, they may look trivial, but as soon as you zoom out and think about running a business at the highest levels, these are the kinds of data sets that you need to answer the most pressing questions that these executives have. So with that in mind, if you liked the video, please click the like button. Also, please subscribe. It really helps me make sure these videos can get in front of as wide an audience as possible. I really want to be able to teach more and more people to become business analysts, more and more people to really embrace this change in career trajectory that they're on to. This is all stuff that I worked hard to learn on my own and develop and practice and socialize with people inside of these companies. And when I'm looking for new people to join my strategy team, these are the kinds of skills and levels of awareness that I'm looking for. And I realize that it's much better if I just go ahead and create some of these videos and help teach people what I have to learn and then help learn from the audience. I'm sure I'm going to get great comments and feedback about how people do this stuff differently and better and smarter and faster. And so it gives me a great opportunity to learn as well. So please click the like button, please click the subscribe button, click that little bell next to the subscribe button so you don't miss any of the new videos. I plan to do one of these a week on a new company or a new kind of analysis. Maybe we'll look into some Bureau of Labor Statistics data so we can study the Great Resignation, or maybe we'll look into some interest rate data to get a sense of how capital investment programs might unfold at some of the world's biggest companies. So we can do all of that kind of stuff. So let me know in the comments if you have any ideas about how you want to see this channel evolve going forward, what topics we want to cover. I look forward to reading all that you have to say, and thanks a bunch for stopping by. Bye-bye.